name is Jim Schlagig. Very recently, I was in the Middle East heading a group there, one of the first banks to specialize in wealth management in the Middle East. And our mission there was to provide real estate as well as private equity and brokerage services to literally billionaires. So I preach in my book, therefore, and in the public speeches that I make, that it's time for us to get risk sober and get back to income and earnings fundamentals. It's time to really take a hard look at the income that an investment puts in your pocket. Focus on investments that really produce rent income, dividend income, and interest income that you can reinvest. If you don't know if a stock, bond, or piece of property is reasonably priced, test to see what kind of income it produces, and you'll quickly see if the price is reasonable or not. That's not just me talking. There's been a lot of research by people such as Robert Schiller from Yale University, Department of Economics, Jeremy Siegel, who's a professor of finance at the Wharton School, Rob Arnott, etc. These people found some things very interesting when they did an analysis of past history. What they found was that a dividend-paying stock increased almost always more when the market rose and actually lost value less when the market came down. If you had invested in the top 30% of dividend-producing stocks, your return was going to be almost three times more. When markets contracted or corrected, there's much less loss with an income-paying investment. So if I'm right that we're going to have more turmoil ahead, and you people seem to believe that there's more turmoil possibly coming, if we're collectively right, then we're going to be better off holding investments that pay income. When you take an income-focused approach, as I'm recommending, you get yourself into some trouble. And that trouble is that most dividends are paid in certain sectors more than others, utilities and financials. So you have to take a look at making some of those investments that eliminate, if possible, some of the financial side. Utilities I don't think are necessarily bad, but the financials in the States certainly are. And I think we want to take a breather from those until we find out where all this mortgage-backed security paper actually went. A lot of it went into our pensions, and a lot of it went into money market funds, and so you have to be very, very cautious about who owns that paper, because it probably doesn't have very much value. Let's separate the real estate investment trust, because although the returns are called dividends, it's really basically one of two kinds. They're either focused on mortgages, which are highly dangerous. If you have those, please eliminate those and look for a higher ground. Or they actually produce rent, and the rent is paid to you as quote-unquote a dividend. Those can be very attractive. Some of them are in commercial properties, or what I like are healthcare properties such as hospitals, which lease their premises, rent their premises. You don't want nursing homes because, in parentheses, nursing homes are paid for often by Medicaid or Medicare, and that's problematic. But you do want clinics and hospitals, and those will probably have greater value over time. So there are some of those investments that are still worthwhile. But there are a lot of income-producing investments, Canadian energy trusts, other kinds of trusts that we're going to see build over the issue of alternative energy developments. There are going to be a lot of income-producing investments that will be very attractive, and some of them already exist. And you can get some of those by ETF. Today we have a large number of indexes that are available for layman investors, where the investments are, the index is created exclusively on the base of dividend-producing stock, or high earnings-producing stock, or low PE stocks. So there are some nice alternatives on the international front that you can look at that are dividend plays, broadly diversified, where you'll be invested in 1,500 of those stocks and putting money in your pocket. And for the more sophisticated investors, trusts that you can get into, like the Canadian Energy Trust, that can be very, very worthwhile. And now they won't be giving us the same 18%, but they're going to give us 9 to 14%, and that's a very attractive return.
Dividend-paying stocks, what happens to them in inflation? You know, if inflation really gets out of hand, if it gets to 20%, 30%, 40%, how will they perform?
Well, as a general rule of thumb, assets tend to go up, as you know, when we get into an inflationary environment. It means that we've got an awful lot of cash in circulation, too much, and people are buying assets. Stocks often go up during inflationary periods. But the point is, they go up, but the quote-unquote, the intrinsic value that I argue that you have to look for in terms of what the earnings potential is, that kind of gets lost in the shuffle. So when we get into a super inflationary period, we get into real trouble because the only thing that's probably going to hold for us will be energy and certain commodities where there's a much more distinct valuation that we can experience. Stocks, we're going to go through a problem period of understanding, yes, the prices will go up. Will they go up in a way that really reflects what's happening with the underlying earnings that you're buying? And my fear is that very often you'll be buying, the value of your stock will quote-unquote go up, but the true value and the true earnings potential that you're earning are not going to be as strong.